SCHG has been getting a lot of attention recently. It's cheaper than QQQ. It's more diversified. And if you only look at recent performance charts, it even looks like it's catching up. So it's no surprise that more and more investors are asking the same question. Can SCHG replace QQQ? In this episode, I'm going to answer that question using real data, not hype, not opinions, and not short-term narratives. We'll walk through what SCHG actually is and how it's constructed, how it has performed versus QQQ across multiple market cycles, the key differences in the underlying index methodologies, and real-world company examples that explain why those differences matter. I'll also share a perspective that I haven't seen discussed clearly on YouTube, especially when it comes to what SCHG misses and why that matters over the long term. After going through all of this, my conclusion is clear. SCHG cannot replace QQQ. Not because SCHG is a bad ETF, but because these two funds are designed to do very different things. Before we begin, a quick disclaimer. This video is for educational and informational purposes only and is not financial advice. With that out of the way, let's begin. Let's start with the basics. What SCHG actually is. SCHG stands for the Schwab US Large Cap Growth ETF. As the name suggests, it's designed to provide exposure to large US companies classified as growth stocks. Under the hood, SCHG tracks the Dow Jones US Large Cap Growth Index. This is a rules-based index where companies are selected and weighted based on growth characteristics such as earnings growth, sales growth, and other fundamental signals. It's not tied to a specific exchange, and it's not built around a single sector like technology. In terms of scale, SCHG has grown into a very large ETF with around $52 billion in assets under management. That level of AUM matters because it implies strong liquidity, efficient tracking, and institutional-level stability. Finally, there's cost. SCHG's expense ratio is 0.04%. That puts it among the lowest cost growth ETFs in the US market, especially for a fund focused on large cap growth. So before we talk about performance or comparisons with QQQ, it's important to understand this. SCHG is designed as a low-cost, rules-driven, long-term growth ETF. What it does well and what it gives up comes directly from that design. When investors compare SCHG and QQQ, the first thing they usually look at is recent performance. And by the look of recent performance, you might assume that SCHG is basically QQQ plus extra diversification. At the top, the holdings do look very similar. But when you look under the hood, the overlap is much smaller than most investors expect. Out of the 102 stocks in QQQ, only 44 are also included in SCHG. That means more than half of QQQ's holdings are completely missing from SCHG, despite both being labeled as growth ETFs. And this is exactly where the confusion starts, because when you look at returns by period, the story looks mixed. Year to date, SCHG is up 18.98%, while QQQ is higher at 22.31%. Over 1 year, SCHG returned 16.06% compared to 19.58% for QQQ. Over 3 years, they are almost identical, 33.98% for SCHG versus 33.30% for QQQ. Over 5 years, SCHG shows 16.23%, while QQQ is at 15.67%. Over 10 years, SCHG delivered 18.24% annually, but QQQ still leads at 19.52% annually. Looking at numbers like these, it's easy to conclude that SCHG has effectively caught up. And that's why many investors start asking, if performance is so close, why not just replace QQQ? But when we step away from snapshot periods and look at year-by-year returns, a clear historical pattern appears. Yes, there are individual years where SCHG outperforms, but in the majority of years, QQQ comes out ahead, especially in strong growth environments. If you go all the way back to 2010, the pattern is the same. QQQ simply captured more upside over time. So while short-term results can look mixed, historically, QQQ has won far more often than it has lost. There are a few years where SCHG edges ahead, but historically, QQQ wins more often than it loses. The gap in any single year may look small, but over time, those differences compound. To remove cherry-picking entirely, let's look at the most realistic test possible. A dollar cost averaging backtest starting from SCHG's inception using the same period, from 11th of December 2009 to 28th of November 2025, and the same contribution amount and frequency, just $10 daily. One portfolio holds 100% QQQ. The other holds 100% SCHG. Over roughly 16 years, total contributions were identical at $40, $160, The QQQ portfolio grew to approximately $227,000, and the SCHG portfolio ended at about $193,000. That's a difference of more than $34,000 using the same cash, same timing, same discipline. And to be clear, this doesn't mean SCHG performed poorly. From inception, SCHG delivered a stunning cumulative return of roughly 381%. But that result is dwarfed by QQQ's even stronger cumulative return of about 466%. That's an 85% gap, created not by luck or timing, but by structural differences that compound over time. In annualized terms, QQQ's return is 19.0%, and SCHG's return is 16.8%. This is not a short-term anomaly. This is the effect of structural differences compounding over time. So here's the core insight. Short-term charts make the funds look interchangeable. Period comparisons create confusion, but long-term real-world investing tells a consistent story. SCHG has not historically been superior to QQQ, even with disciplined dollar-cost averaging. Which brings us to the most important question. Why does this gap exist at all? And the answer has nothing to do with hype. It comes down to index construction and what each fund is allowed to own. To understand why these two funds diverge over time, you have to stop looking at performance and start looking at how the indexes are built, because this gap doesn't come from luck, timing, or hype. It comes from rules. Starting from SCHG, it tracks a U.S. large cap growth index. The starting universe is roughly the 750 largest U.S. companies. From there, every stock is classified as either growth or value using a purely quantitative framework. That classification is based on 6 metrics: projected earnings growth, projected price to earnings, price to book, dividend yield, trailing revenue growth, and trailing earnings growth. If a company fails those growth tests at a rebalance, even temporarily, it can be reduced or removed. That's not a judgment call, it's mechanical. Nonetheless, QQQ works very differently. It doesn't classify stocks as growth or value. It simply holds the largest, most liquid, non-financial companies listed on NASDAQ. If a company remains big, relevant, and traded, it stays. There's no requirement to pass a growth screen every year, and that single difference explains almost everything that follows. Why growth screens don't guarantee better growth? This is the key misconception. A fund labeled growth does not automatically outperform a fund that isn't. In fact, SCHG's growth screen can be too restrictive. It tends to penalize companies that operate in cycles, reinvest heavily, or experience temporary earnings pressure, which brings us to what SCHG actually misses. First, cyclical growth leaders removed for short-term reasons. When we look at QQQ holdings that are not in SCHG, we don't see weak companies. We see names like Micron, Shopify, Lam Research, Qualcomm, and Applied Materials. These are long-term growth engines, but they operate in cyclical industries. Their earnings fluctuate, their valuations compress, and that can cause them to fail a growth screen temporarily. Removing these companies based only on short-term metrics is extremely myopic. QQQ stays invested through those cycles, whereas SCHG doesn't. The second difference is geographic. QQQ includes global leaders such as ASML from the Netherlands, Shopify from Canada, PDD from China, and Mercado Libre from Latin America. These are some of the most dominant growth platforms in the world, but SCHG is limited to U.S. stocks and U.S. growth classifications. That means entire sources of global innovation are excluded by design. QQQ captures growth wherever it happens. SCHG can't. The third difference surprises a lot of people. QQQ actually holds several defensive cash-generating businesses that SCHG leaves out. Names like Honeywell, Starbucks, PepsiCo, Amgen, Cisco, and ADP. These companies don't add excitement, they add stability. And that's why QQQ isn't as volatile as its reputation suggests. When we look at risk-adjusted returns, QQQ's Sharpe ratio is about 0.88, compared to around 0.81 for SCHG. That tells us QQQ's volatility has been more than compensated by returns, and SCHG's more diversified holdings don't reduce its volatility as expected. On the surface, the funds still look alike. The expanded technology sector, including Google, Meta, Netflix, Amazon, and Tesla, makes up roughly 73% of QQQ and about 69% of SCHG. That difference looks small, and that's why many investors assume the outcomes should be the same, but they aren't. Because what matters isn't just sector exposure, it's which companies are allowed to dominate and how long they're allowed to stay. QQQ is built to capture leadership and momentum wherever it appears for as long as it lasts. SCHG is built to enforce growth discipline, even if that means exiting future winners too early. That's why SCHG can look smarter in theory, and it's also why, in practice, it hasn't replaced QQQ. Now that we understand how these two indexes are built, the next question is simple. Does this structural difference actually matter in the real world? So instead of theorizing, let's test it using real companies, real inclusion dates, and real returns. Same market, same time periods, no hindsight edits. The first example is Shopify. The company was added to QQQ on 19th of May 2025. From that date through the end of November 2025, Shopify delivered a return of 36.83%. Over the exact same period, SCHG returned just 19.70%. That's nearly double the return. And here's the key point. Shopify wasn't excluded from SCHG because it was a bad business. It was excluded because at that moment, it didn't pass a quantitative growth screen. QQQ didn't ask whether Shopify's short-term metrics looked perfect. It asked a simpler question. Is this company large, liquid, and relevant? That difference allowed QQQ investors to participate in the upside, while SCHG investors couldn't. The second company is more prominent, ASML. The Dutch semiconductor giant was added to QQQ on 18th of December 2017. From that date through the end of November 2025, ASML returned approximately 559.41%. Over the same period, SCHG returned about 290.97%. That's not a marginal difference. That's nearly a 2x gap. And unlike Shopify, ASML wasn't excluded because of growth metrics. It was excluded because it isn't a US company. SCHG never had the option to own one of the most important semiconductor companies in the world, but QQQ did. What these examples actually prove is not cherry-picked success stories. They're structural outcomes. QQQ is designed to keep leaders through cycles, capture global innovation, and allow winners to compound without interruption. SCHG is designed to enforce discipline, rotate based on metrics, and accept that some future winners will be filtered out. Neither approach is wrong, but they are not interchangeable. And when you combine these real-world examples with the long-term DCA results we saw earlier, the conclusion becomes very clear. SCHG can complement QQQ, but it cannot replace it. So after looking at the data, the performance history, the index methodologies, and real-world company outcomes, the answer is clear. SCHG cannot replace QQQ, and not because SCHG is a bad fund. SCHG is low-cost, rules-based, diversified, and extremely disciplined. But that discipline is also its limitation. Its growth label is driven by quantitative screening, not by market leadership. When companies temporarily fail those screens, even world-class businesses, they can be excluded. And once they're out, SCHG misses the upside. QQQ doesn't try to define growth. It simply holds the most important companies trading on the NASDAQ. That structure allows international leaders like ASML, keeps innovative but volatile names like Shopify, and includes defensive compounders like Starbucks and Honeywell. The result is higher volatility, but also higher compensation for that risk. That's why QQQ's Sharpe ratio, around 0.88, is higher than SCHG's 0.81. QQQ doesn't just swing more, it gets paid for it. Over roughly 16 years, using identical DCA contributions of 4,160, QQQ grew to about $228,000, and SCHG ended around $193,000. That's a difference of more than $34,000 from structure alone. Same cash, same discipline, different outcome. The real insight here isn't choosing one over the other, it's understanding how they fit together. These two funds already share a meaningful overlap. The core mega-cap growth companies. That overlap becomes your foundation. On top of that, SCHG gives you exposure to a strict quantitative growth methodology, and QQQ gives you exposure to NASDAQ's market-driven selection of innovation leaders. One captures what screens well on paper, the other captures what actually rises to the top of the market. Together, you get cost efficiency, style discipline, global innovation, and structural flexibility. You're not betting on one definition of growth. You're letting multiple growth engines work at the same time. SCHG looks like a QQQ replacement on the surface, but once you zoom out, the structure, the exclusions, and the compounding paths diverge. If you're investing for decades, the data doesn't support replacement. It supports combination, a shared core, two different engines, one long-term portfolio, and that's the difference between following a label and understanding a structure. This video is for educational and informational purposes only. It is not financial advice, investment advice, or a recommendation to buy or sell any securities. All analysis is based on historical data, index methodologies, and publicly available information, which may change over time. Past performance does not guarantee future results. Please do your own research and consider your personal financial situation before making any investment decisions.